Morning, dear members of Chembur Study Circle. I would like to thank Piyush sir for accepting our invitation for today's VCN. And I would also like to thank the chairperson of WIRC, Preeti ma'am, for joining today. It's our gratefulness to have you today with all of us. Before starting officially with the VCM, I would request Preeti ma'am to say a few words, ma'am, please.
Thank you, Pankaj, and welcome to Piyush Bhai to our study circle. And I appreciate again always the efforts of Pankaj and Shikha for doing a great work even in pandemic. I know the entire schedule of next month is also fixed by them. So really great work, Pankaj, and really superb topics, relevant topics, and best of the speakers you are putting for sharing the knowledge to the members. My appreciation. Thank you. And I hope everyone is safe and healthy in this pandemic. Thank you.
Thank you, ma'am, for your kind words. Starting with the VCM, I would like to say a few words for CA Piyush sir. Piyush sir is in CA practice since 21 years. He's a senior partner with Messrs. Chhajed and Piyush Chartered Accountants, established on 1st September 1964 by late CA S.P. Chhajed, past president of ICAI. Sir is having a specialization in direct and indirect tax appellate proceedings and arbitration proceedings. Also a speaker on various topics of direct tax. He is also a member of External Advisory Committee of Reserve Bank of India for Asset Reconstruction Company 2019 onwards. He is also co-opted member of Central Council Committee of Strategy, Perspective Planning and Monitoring Committee ICAI 2019-20. So is also a member of study group formed by ICAI for revision of publication guidance note on tax audit under section 44 AB of the Income Tax Act 1961. So is also a special invitee on Central Council Committee of Direct Tax of ICAI 2018-19. He is a co-opted member of Central Council Committee on Government Accounting of ICAI. He is also co-opted member of Central Council Committee of Board of Studies of ICAI 2004-5. As far as WIRC is concerned, he is also a co-opted member of Direct Tax Committee of WIRC, co-opted member of Direct Tax Committee of WIRC for 2019-20 and 2021. He is a group subgroup member of Journal Committee of Western India Regional Council of ICAI 2007-8. Subgroup member of Professional Development Committee of Western India Regional Council of ICAI 2017-18. Subgroup member of CPE Committee of Western India Regional Council of ICAI 15-16. He's also a member of Direct Tax Committee of Chamber of Tax Consultants for 2019-20. He's a contributor to WIRC publication on Vivad Se Viswas Scheme 2020-20. He's a reviewer of FAQs on charitable trust published by Jain Chartered Accountants Federation, Mumbai. He's a contributor to WIRC publication on Finance Bill 2021 as well. As far as other engagements are concerned, he's an independent director with Cello Group, honorary vice president for Jain Chartered Accountants Federation, Mumbai. He also joint treasurer for Sri Vijay Himachal Suji, Kirti Stambh, Khanirao, Rajasthan. He's also a trustee of various trusts. So with this very impressive achievements of his career, I would request CA Piyush sir to comment the VCM, sir. Thank you, sir.
Thank you, Pankaj, the convener of Chembur CPE Study Circle, Deputy Convener Shikha. I also thank the past chairperson of Western India Regional Council, Preeti, for being over here. In fact, for facilitating this occasion, in fact, I would say, and thank to her for joining there. And I also thank all the esteemed members who join on this Sunday morning for the Finance Act 2021 amendments. Obviously, as we know that Finance Act 2021 is now almost past, which is now 50 days old. It was passed by Lok Sabha on 23rd March and assent was given on 28th March. So already Finance Act 2021 is in place and it has to be implemented for this year, because if you see the Finance Act 2021 provisions, a lot of provisions are applicable retrospectively technically because it is applicable for financial year 2021. And most of our members will be now in course of finalizing financial year 2021 audits, tax returns, and therefore this amendment also becomes relevant. Generally, Finance Act 21 would be applicable for assessment year 22-23 technically, and financial year 21-22. So it's a forward, but the most of amendments, because are applicable for 2021 and 21-22, it will be relevant for both the years, the current year which is going on and the year which has gone by. And as a chartered accountants, we are supposed to look into it. We need to apply that and advise our clients on those provisions. In my presentations, before I start presentations, I'll just tell you, I have tried to make, there are a lot of changes between a finance bill and Finance Act 2021. I'm sure your study circle would have already done a program on finance bill. That is a budget immediately after the budget, and you would be aware of the budget provisions. Obviously, there won't be such a detailed presentation or exercise which generally happens post budget. It is more with the point of view of just appraising on the what changes have been made. My idea would be to go little detail into it, certain provisions 4 and 5, which are very big important amendment provisions, which I would try to discuss in detail along with the examples. And there will be also other amendments which have come in Finance Act 2021. I'm not comparing bill to act, but whatever amendments that have taken place and that are in force today, I have tried to cover that. So I'll also go through those small amendments. So at least we have a brush of it. So my concentration would be on 4 or 5 important amendments, which has implication day to day. We need to understand, we need to thresh it out and actually apply in our practice or our advice to the clients. So we need to keep it in mind. And then I will thresh it throughout the other provisions also to just refresh what has happened in the budget. So as we know that Finance Minister Nirmala Sitharaman presented the Union Budget on 1st February of 2021. And this budget was given, there were a lot of amendments made for the financial year 21-22. But as I said earlier also, there were also amendments which are effective from financial year 2021. And therefore, as a practicing chartered accountant, you will have to keep it in mind even this year when you are finalizing your audit, when you are finalizing your tax audit, or you are advising your clients, because there are a lot of implications that is going to happen in 2021 itself. Of course, the provisions, other provisions which are applicable from 21-22, you have to keep it in mind, appraise your clients, advise your clients on this. There are encompasses a lot of amendments in this. This bill was passed by the Lok Sabha on 23rd March 2021, and ultimately an assent was given by President on 28th March 2021. So as I said that there is an amendment, the bill act has come into force from 28th March 2021. So the question in this budget, in this act remains is the amendments which are effective from 1st April 2021. You have only 2 days or 3 days technically when the act came into force, but it has been applied to 1st April 20. So there is in effect a lot of provisions are of a retrospective nature, not a retrospective from a year-on-year basis, but at least wherein you have already completed 363 days of that particular year. And now you have been told the transactions which you have been entered would be looked into a particular manner, or the new provisions would be applicable to them. And therefore, it amounts to a retrospective taxation as far as those amendments are concerned. Certain amendments which are 21-22, they are not in retrospect, they are in the prospect, and those amendments are also quite a bit which we will be looking into it. Post assent given on 28th March 2021, a Finance Act was published by the government. It was notified into official gazette. But there were 2 corrigendums also issued on 6th April and 15th April. Though those corrigendum was to rectify certain mistakes, and it has been discussed across both. There was certain mistakes which were technical mistakes and which was not actually bringing out the objects. So those technical clerical mistakes have been rectified. That's what the corrigendum says. And while making my presentation, obviously I have considered up to 15th April. It's an act in force today. as I said, I will be concentrating on the 4 or 5 major amendments which have a major implication in our day-to-day applications. And also I will cover up all other amendments. I will take it through you, maybe on a faster note. The most important amendment which we have been talking is in regard to, we have been talking on goodwill even after during the budget. At the time of the budget, there was a lot of discussion why this has been done. There was always a dispute whether the goodwill is to be considered as an intangible asset and whether the depreciation will be allowed under the Income Tax Act. These disputes were going before various high courts. After the Supreme Court judgment in case of Smith Securities 348 ITR 302, it was held that goodwill of a business or profession is a depreciable asset. So goodwill is covered under the block of intangible assets. Once it is covered under the block of intangible assets, you were entitled to a depreciation of 25%. Now this judgment of the Supreme Court Smith Security, I believe, has not gone well with the government, and they feel that this was not an intention. Their intention was never to grant a goodwill a depreciation, and therefore an amendment has been made. Now this amendment, as I said, is effective from financial year 2021. What we were doing previously, we were claiming all acquired goodwill. Generally, goodwill arises when the businesses acquire other businesses, when you take over other company. So the goodwill calculation is done in accordance with AS 14. As per accounting standard on 14, in case of mergers or amalgamations, any price which is paid by the acquirer to the seller, by the buyer to the seller, over and above the book value of assets, was being debited to goodwill. Though, because the goodwill is a hotwatch of the various other activities, various other licenses, various other rights which you are getting. But because my AS 14 says that this all will be termed as goodwill, it was been classified as a goodwill. Though AS 14 does not apply to the slum sale, but even in the case of slum sales under Section 50B, which was happening under the Income Tax Act, was recognized under the Income Tax Act. Whatever amounts were paid over and above the net worth of the assets sold under the slum sale was recognized as a goodwill as a matter of convenience. Though it was purely not a goodwill, it was a block of various other assets and licenses and rights. So the goodwill was capitalized at that moment of time, and this goodwill was allowed a depreciation at the rate of 25% under the Income Tax Act as per intangible asset block of it. Now, the government wants that this should not be done and it should be effective from 1st April 20. So for the purpose of disallowing the depreciation from financial year 2021, they have also asked you to remove the WDV from the block of a goodwill to the extent it has been already suffered. So if my goodwill was 100 rupees and I've already claimed certain depreciation on those goodwill account, then your WDV of that block of assets has to be revisited. So when you are doing an audit for your 1st April 2022-21 financial year, obviously your WDV of intangible assets will have to be reworked. You will have to calculate goodwills which has been claimed on those goodwill, depreciation which has been claimed on that goodwill will have to be taken out. So whatever is the net block book value of that goodwill has to be taken out from the WDV. For purpose of giving this effect, a lot of definition changes has been done in the Finance Act. Example, Section 211, which is the definition of the block of asset, the goodwill has been excluded. Similar amendment has been made under Section 32, bracket 1, bracket 2, and explanation 32, Section 32. According to which goodwill of a business or provision shall not be considered as an asset and shall not be eligible for depreciation. In short, all these amendments are in relation to change in the definition of intangible assets. The intangible assets included a commercial, it had a residuary entry, any other. So it's like that, if intangible assets was patents, copyrights, and any other commercial or similar rights. So Supreme Court in the Smith Securities had held that any other commercial or similar right would include goodwill. So now a specific amendment has been made in the provisions of the Act that any other commercial or similar rights do not include goodwill. So goodwill has been specifically excluded. There is another provision added under Section 50 bracket 2. 50 bracket 2 deals with the calculation of depreciable assets. So as I said, that you will have to rework as on 31st March 20, that is 1st April 20, WDV of intangible assets and the WDV of goodwill. The WDV of goodwill has to be taken out, and only the balance intangible assets other than the goodwill, the WDV will continue and the depreciation will be allowed. Similar amendment has been made in section 55 bracket 2A, which is deals with the cost of acquisition. Goodwill is purchased by an assessee. The cost of acquisition, that is purchase price for section 48. What happens once the goodwill comes out? Obviously, once the goodwill comes out of the section 50, that is, it does not remain a depreciable asset. And if later on the goodwill which has been acquired is been sold, or there would be a capital gains calculation. So for the purpose of allowing a deduction, there is an amendment made in section 55. Goodwill is purchased by an asset. The cost of acquisition for that will be the purchase price for section 48. So the cost of acquisition would be the purchase price for section 48. Assessee has claimed and has been allowed depreciation prior to assessment year 2021. Then the depreciation so claimed shall be reduced from the amount of purchase price of the goodwill. So either the cost of acquisition or the WDV as on 31st March 2020 would be treated as a cost for the purpose of section 48. That's what the amendment is. These are the examples which I have given for the purpose of computing the goodwill, case 1 and case 2. Of course, I would be sharing this presentation with the convener who can share with the members. I would request. So this are the only examples, but in nutshell, what it is, the WDV of the goodwill will be so. In this example, I have taken an intangible assets block contains of the 3 particular intangible rights. One is goodwill, one is trademarks, one is licenses and franchises. Effective 1st April 20, the goodwill is not allowable as a depreciation, but trademarks and licenses and franchises are allowable. So what I will have to do as of 31st March 20, I will have to work out what would be the impact of the goodwill. So if there is an asset sold during the year, there is another intangible asset sold during the year, you will have to rework those blocks correctly. If you see in this example, in particular, I have done an adjustment on account of goodwill. So the block opening WDV of 82.50 has been reduced by the actual adjustment on account of goodwill, which includes the original cost of goodwill less depreciation allowed on the goodwill during the financial year 18-19-20. So if my original cost of goodwill was 100, the depreciation was already allowed to the extent of 43.75. So balance 56.25 is my block of goodwill, which is included in opening WDV, which contains 3 assets. So that 56.25 has been reduced from that. And only on the balance WDV, which now consists only of trademarks and licenses, a depreciation is claimed at 25%. So this is how the working will have to be done to give an effect to the amendment made in section 50. Now the key important points which according to me may still arise. Now the question is, this goodwill amendment provision has come from financial year 2021, that is assessment year 21-22. The act has been passed on 28th March. While making an advance tax payments, obviously I have considered the depreciation allowable on the goodwill and accordingly advance tax payment would be made. But to now onwards, because the advance tax would go down, your depreciation liability on goodwill, depreciation claim on your goodwill will go down. Once your depreciation claim goes down, your taxable income will go up and tax liability will go up. Obviously, you have not made advance tax payments. So there would be an impact of 234B and 234C on this. Now the question is, if you actually look into the amendments of the section, it clearly says that any other commercial rights of a similar nature, excluding goodwill from the definition of block of assets and not any other intangible assets. So what is the goodwill has been excluded? My now attention I would draw is to the judgment of Delhi High Court in case of Areva Tea and India and even Hindustan Coca-Cola beverages, wherein a depreciation was claimed of goodwill by the assessee on account of falling. And Delhi High Court says that this does not mean only a goodwill. At this time, it was not that the depreciation was allowable on the goodwill. So the assessing officer said that because you have capitalized a host of activities by the name of the goodwill, I will disallow. A Smith security was not there at that moment of time. At that moment of time, not ruling that the goodwill is part of intangible asset and depreciation is allowed, but still a depreciation was allowed, stating that goodwill does not mean purely goodwill is a bucket of various other rights and obligations and the assets, such as payment made for marketing and trading reputation. So there is a reputation of a company. When you acquire a business, obviously you are acquiring those marketing and trading reputation. You acquire a trade style and name. You acquire territorial know-how. Territorial know-how means your know-how, the penetration in a particular geographical market, habits of consumer in the territory, patents, trade secrets, marketing rights, business claims, records, employees, Even the employees is an asset. If you are starting a new business, you do not get those skilled employees. That's why you generally, when you are taking over a particular running unit, running businesses, obviously you have a condition that all the employees should join. They should continue with the buyer company. Marketing and distribution agreements, rights, informations, copyrights, trademarks, customer list, franchises, business informations, contracts, know-how, data list, which is not appearing. So Delhi High Court has held that goodwill is a bucket of various other services. So depreciation cannot be disallowed under the goodwill. To my mind, even after this amendment, nothing stops an assessee to actually bifurcate this goodwill into under this various heads. Can I do that? Let's take an example. There is a sum sale which is happening. And if there is a company takeover, if there is a merger, obviously AS 14 is applicable. So you will have to continue to capitalize everything in the goodwill. And before the income tax officer, you will have to claim that this goodwill is a bucket of services. But let's take an example of some sin where AS 14 is not applicable. So do you mean to say, does it means that I can actually, whatever amount I have paid over and above the net worth of that particular seller unit, can I capitalize under various heads and continue to claim the depreciation? To my mind, yes. The question will arise, how would assessing officer then decide that what is attributed to actually goodwill and what is attributed to other various rights which fall under any other commercial or similar rights, and therefore depreciation is allowed? There is a valuation can be done. Whatever amounts you have paid over and above net worth can be valued. There are specific valuation reports should be obtained that out of this, let's take an example, net worth is 100 rupees. I am paying 150 rupees as a transaction value as a buyer on a slum sale. I capitalize 100 rupees net worth assets into my books. This balance 50 rupees has to be allocated. I can allocate certain amount to immovable assets if there is a value differences, that is land and billing. Certain other amounts has to go to either goodwill or other various rights. So that the bifurcation will have to be done. If that bifurcation is done, according to me, it will be an easier for you to continue to claim depreciation on such intangible assets. If it is taken as a bucket and you do not do a bifurcate and it goes into a goodwill, then obviously the assessing officer will disallow. But it can be still reasonably argued that this goodwill does not mean purely goodwill. It is the rights of any other commercial or similar nature, which includes the following, as laid down by Delhi High Court. Key points, just to summarize, the goodwill is ineligible for depreciation. So opening balance of the goodwill has to be reworked. Once the goodwill does not remain a depreciable asset, it moves into a capital asset. And when you sell it, obviously a capital gains has to be worked out. Cost of acquisition of self-generated goodwill will be nil. So the question is, once if it is a nil, can it be argued that the computation mechanism fails? The old judgment of BC Srinivasa Sethi can be applied. In case the goodwill is acquired, then obviously the purchase cost would be treated as cost of acquisition under section 48, as we have seen, plus minus any depreciation if we would have claimed before 31st March 2020. So these are the key points. Another important amendment which is made in section 50B, which is in the slum sale. Now the slum sale is which we have been discussing, where the lump sum consideration is paid for a unit as a whole. So this unit, let's take an example. A company is having a manufacturing unit, and I have 2 or 3 manufacturing units, one in Gujarat, one in Kolkata, one in Tamil Nadu, and so on and so forth. And company decides to sell only one particular unit. So there is a provision under section 50B where the unit is sold for a lump sum consideration, where the consideration is not allocated to a particular asset. It would be treated as a slump sale, and you get a benefit of long-term capital gains. So tax is payable as a long-term capital gains. The reduced tax rate of 20% has to be paid. And for the purpose of this, it would be treated as long-term the day when the unit was the first started, the installation of the unit. For the purpose of this, the calculation formula was given under section 50 capital B, that whatever consideration is received for the against this lump sum would be treated as full value of consideration. Expenses in relation to the transfer and the net worth would be allowed as a deduction, and the balancing figure would be taxed at the capital gains. Now, this full value of consideration was actually a transaction value. So now there is a twofold amendment. One is an amendment made in the definition of this lump sum. And the second amendment has been made that how the fair market value would be replaced with the transaction value. So the first amendment has been made in section 2 bracket 42C of the slum sale, which actually, as per the current status before Finance Act 2021, stated that slum sale means transfer of one or more undertakings as a result of the sale for a lump sum consideration. So as a result of the sale, without values being assigned to individual assets and liabilities in such sales. So question was the transfer of one or more undertakings as a result of the sale. Now there was a lot of litigations going around this, that what do you mean by as a result of the sale? In certain cases, there were divergence views taken that if there is a slump action, let's take an example, there is a slump sale and a buyer unit, instead of paying cash for acquiring a unit, actually settles this consideration by way of allotting the shares. So in the Bombay High Court, in one of this particular case, in case of Bharat, they held that this is not a transfer in terms of section 247, and therefore it is not a sale in terms of section 2 bracket 42C, and therefore these sunset provisions will not apply. Bombay High Court in Bilji held that transfer of its lived, if you read this provision, read the observations, transferred its lift division to another company in terms of scheme of arrangement under 391, read with 394 of the Companies Act, in view of the fact that the consideration for said transfer was not determined by parties in terms of money, but its disbursement was to be in terms of allotment or issue of bonds. It was to be regarded as a case of exchange and not a sale. So exchange, whereas sale is not defined. So there was no transfer applicable, there was no exchange. If the definition included a transfer, it would have been taxable, but it only said as a result of sale. So there was no mention of transfer, there was no mention of anything else. And therefore there was the different divergence views. Of course, Delhi High Court held that slum exchange transaction would be still taxable, but there were divergent views on this. And to cover up this divergence views, transfer which is in effect, if you see, there is another judgment of Ramakrishna Pillai, then also it was held that a non-monetary considerations, if a transfer of an asset in lieu of another asset, it can be said to be monetized in a situation where the considered asset is ascertained first and then discharged by way of non-monetary. In this, it would be a case of transfer and would be covered within the provisions of 50C. So though there is a 50C, the Supreme Court in a particular case held that the non-monetary consideration would be also treated as a monetary because the value can be ascertained. So there would be a lot of divergent views in this, that whether the barter transactions would be really covered under the slum sale. To cover up this, a definition of slum sale has been amended. Section 242C has been amended. What does 42C amended provision says? Transfer of undertaking as a result of sale to transfer of undertaking by any means. So if you see transfer of undertaking as a result of sale to a transfer of undertaking by any means. So sale has been replaced by any means. All types of transfer as defined in 247 are included within the scope. Now slum sale by way of exchange will also be covered, and now paying cash consideration is not necessary. This will bring cases like sale of business divisions against equity shares also within the ambit of slum sale. So there was an issue why this exchange was being done. Now the question arises, when there is a slump exchange, there is no money received. Amount is not received. Sometimes within the group companies, a restructuring has been done. One particular unit has been sold by a holding company to a subsidiary company, by one group entity to another entity, just to work on the economies of the scale or with their other objectives, other commercial objectives, and not really with the tax planning. Those such exchanges, according to this, there was no monetary consideration being paid, and those were settled by way of issue of the shares. Now, all those restructuring proposals amongst the group companies will have to be re-looked into it if there is a tax implication. Moreover, initially, those tax, there was not much a tax liability also because the transaction fair value of the consideration was transaction value. So if the transaction value was equivalent to net worth of the company or the book value, obviously there won't be a capital gain. The transaction value of the consideration minus the net worth of the company is only taxable. Net worth of the unit is only taxable as the capital gains. So all those transactions as will also be now come into this. The people were trying to plan it in a manner amongst the group entities, but not really that actually really there won't be any sale or transfer. Technically, it was only a restructuring happening amongst the group companies. But after this definition amendment, obviously, the provisions of the 242C may be applicable, and now such restructuring proposals may also have to be re-looked into it and run through the amended provisions. As I said, the second amended provisions is 50B2, which says fair market value of capital asset instead of book value shall be considered. Method to calculate fair market value of the capital asset has to be prescribed. The 50B2 has been amended that for the purpose of taking a consideration in case of slump sale, fair market value of the capital assets will be now replaced instead of book value. If the transactions among the group companies was happening at book value, there was no capital gains arising. So book value minus book value, and there was no power under the law to replace those book values. Now 50B2 specific amendment of insertion has been done, which says that the fair market value has to be replaced. So once the fair market value is replaced, obviously you will be subject to tax even among these sister companies transactions. For the purpose of arriving at the fair market value, the methods will be prescribed. I'm sure this will be in line with 11U, 11UA, but the methods has to be prescribed. The power has been taken by the government. As of today, to the best of my knowledge, no such method has yet been prescribed for the purpose of 50B2, how the fair market value would be capitalized. There is another new clause which has been also added in Explain 2 of 50B. Value of capital asset with goodwill, which has been not been acquired by SSC by purchase from Piyush, shall be taken as nil by computing the net worth. So if you are doing a slump sale and you are doing the net worth also, which has there is a capital goodwill which has not been acquired, but the goodwill is appearing in the books. So there is a goodwill all including in that particular unit. For that purpose, the value would be taken as nil. So what is the difference which will happen in the slump sales prior to amendment and post amendment? Now, tax implications. If amount received by the transferor is greater than the fair market value, then in the hands of seller, there is no change, because even today, you are calculating capital gains under section 50B on the transaction value. So even if it is greater than the fair market value, it will not be replaced by fair market value. So there is no implication. What about the amount paid higher by the buyer over and above the fair market value? I'm sure excess consideration need to be recognized as a value for the goodwill or for other commercial rights of similar nature. Now, if I'm recognizing as a goodwill, obviously the assessing officer would say that there is an amendment made and this goodwill is now will not fall under the block of intangible assets, and therefore the depreciation may not be allowed. At this time, we may have to identify this excess consideration to other commercial rights of similar nature. There are various commercial rights which Delhi High Court has listed in its order of Tereva, and which we have discussed earlier. So if the identification can be done and those can be capitalized as other commercial rights of similar nature under the block of intangible assets, so we continue to get depreciation, but not on the goodwill. Goodwill will be treated as a capital asset and a capital gain shall arise on its subsequent transfer. So any amount which is allocated to goodwill and not to other commercial rights will actually be capitalized as a goodwill, which will continue as a capital asset. When you sell it, actually, again, when you further sell it, those will be allowed as a capital gains indexation. Amount received by transferor less than fair market value. Now, if the amount was received less than the fair market value, there is no implication in the hands of the seller. But now, after the amendment, higher capital gains tax liability due to diminution. So, for the purpose of 50B, the consideration would be replaced by the fair market value. So, if you transfer the if the slump sale has happened at 100 rupees, but the fair market value as per the method prescribed, method is yet to be prescribed. If it is 110, the consideration would be treated as 110. So after amendment, the 10 rupees would be additional burden in the taxable income, and the tax thereon would be that additional tax burden. If there is a short consideration which has been paid, what happens in the hands of buyer? Obviously, in the hands of the buyer, it would be treated as a capital reserve. The value of the 100 rupees assets which you have acquired by a slump sale, the buyer will capitalize each and every asset based on the net worth in his books. But he has actually paid 90 rupees. It's a short value only he has paid. So the 10 rupees, the benefit which has accrued, I'm sure this cannot be a taxable in his hands. 56 is not applicable. It should be treated as a capital reserve. As I said, these amendments are also applicable from financial year 2021, unfortunately. So unfortunately, 2021, though the act has been passed on 28th March, you would have planned your affairs. Some say would have already taken place in last 363 days based on the existing provisions. But now you will have to run those transactions to the new provisions and accordingly decide. Though in this particular case, as far as slump sale is concerned, which is taxable to under capital gains, there won't be a 234BC liability, because 234C has an exclusion wherein if the estimation is if the advance tax is deposited is less due to not estimation of capital gains, there is no tax liability. And there is no interest liability. The most important amendment which has been discussed, it's the lengthy amended provisions, is insertion or replacement of new section 4544 in entirety. So existing provisions has been replaced by amended provisions. When the bill came in, there were two sections. One section 45(4) was replaced, and another new section 45(4) capital A was inserted. In the Finance Act, 45(4)A has been removed. Instead of that, section 9B, 9 capital B has been inserted. Obviously, when we look into it, we'll realize when we go through provisions of 45(4) and section 9B, we'll realize why 45(4)A, which was initially proposed in bill, has been removed, and it has been covered in section 9B, obviously, to avoid any discrepancy as far as head of charge is concerned, because 45(4)A deals with the capital assets only, whereas section 9B has now been inserted, includes any distribution or receipt of stock in trade also, and therefore section 9B has been avoided. So there is no controversy as far as head of taxation, head of taxable income is concerned. So what does 45(4) says? What does the existing provision and amended provision says? So 45(4) says taxation, it is in regard to taxation on receipt of capital asset or money by a partner. What was the existing provisions? Existing provision was if there was a receipt of capital asset money by a partner on dissolution or otherwise, only of a capital asset, not of the money. Capital gains tax in the hands of firm only in case of transfer of assets. So money was not covered in the existing provisions, and it did not say that receipt. A receipt was not important. It was a dissolution or otherwise capital gains tax in the hands of firm only in case of transfer of assets. So there was a transfer due to dissolution or otherwise. So technically, in the existing provisions, any transfer of asset due to reconstitution, retirement of partner was not taxable as held by various courts. The various courts have held that reconstitution or retirement do not actually relinquish the right of a partner in the asset. So partner is not different from a partnership firm. Distribution of money was not taxable in the hands of the firm. If anybody goes into the history of this provisions 45(4), what was happening is basically this type of transactions were happening in the real estate industry, wherein the landowners were the partners in the partnership firm, and the book value of those land in the partnership firm would be, for an example, 100 rupees, and the market value would be 500. So instead of transferring that asset and paying tax in the firm, they were reconstituting the partnership firm by the existing landowners were retiring from a partnership firm, and the new partners who was actually wanted to acquire an asset or right in those particular lands or properties in the firm was joining in as a. Now this reconstitution was held not to be taxable by various courts, though there were certain contrary judgments depending upon case to case, depending upon how the agreements were drafted, depending upon whether all the partners have retired together or it has been done in the phased manner. So based on that, controversial judgments were there, divergent views were there, but more or less it was held. Majority of time it was held that it is not taxable as a capital gains. Now to cover up this situation, 45(4) has been amended, and it has been amended also to include receipt of money, because initially receipt of money was not taxable. If my 100 rupees asset is revalued before the reconstitution or retirement of a partner or admission of partner to 500 rupees, so what was the people doing? The existing partners used to revalue assets, and the revaluation amount from 100 to 500, the difference between 400 was credited to old partners account. And at the time of reconstitution, the new partners used to bring in the 500 rupees as a capital contribution, and the old partners used to withdraw the capital. So they used to get receipt of money over and above their original capital investment, but that was not getting taxable as per the judgments of the various courts. Now the amended provisions of 45(4) is substituted, according to which capital gains tax will be chargeable in the hands of the firm on receipt of money or capital asset by partner representing his capital account balance on reconstitution. So no dissolution. Dissolution is not covered in 45(4), only on reconstitution. Dissolution has been covered by section 9B. We'll see further down, but no money. So it has to be receipt of money or capital asset by a partner. If an example, I just revalue an asset in my books of accounts, question is whether 45(4) will be applicable. It will not be. Till the time the receipt of money or capital asset in the hands of the partner is not there, it cannot be taxable. The question may arise, there may be a dispute, there may be an arguable that receipt of money, just an amount credited to a partner's capital account does not mean a receipt. Receipt means actually receipt of money in the account of the partner or receipt of the capital asset by the partner. Just crediting the partner's capital account does not amount to a receipt. It may be argued to that extent, and there may be litigations on this account also. Once there is a receipt of money or capital asset by a partner, the capital gains will be chargeable in the hands of the firm. So firm has to pay the tax on the receipt of money or capital asset by partner in excess of his capital account balance. So if 100 rupees was my capital account balance originally before the revaluation done. So capital account balance is before the revaluation. Value of money and fair market value in case of capital asset will be deemed to be full value. Capital balance of partner will be deemed to be the cost of acquisition. So capital gains will be calculated based on difference in the capital account balance and the amount actually received. So in my example's case, if 100 rupees was my capital account balance before revaluation, and I received 500 rupees based on the fair market value of the asset. If I receive less than the fair market value of that capital asset, then I have to actually replace the fair market value of the capital asset in case of capital asset. In case of value of money, whatever money is received will be the consideration for the purpose of capital gains. So 400 would be taxable as a capital gains in the hands of the firm. So this is the way the calculation of capital gain takes. So whatever value of money has been received by the partners, plus value of fair market value of the capital asset which is received. So if you receive money and capital asset both, then you have to add money and take a fair market value of capital asset. Less balance in capital account, mind it without giving effect to revaluation of assets, self-generated goodwill or any other self-generated assets. So all notional entries will have to be removed before taking into a capital account balance, and the balance has to be chargeable to capital gains in the hands of the firm, AOP or BOI. Before section 9B, no taxability, distribution, division or allotment of assets by a partnership firm upon dissolution or reconstitution is nothing but a mutual adjustment of rights between the partners. So before section 9B came in, there was no tax as per the Supreme Court judgment, and the assessees were arguing based on the Malabar Fisheries case, Supreme Court of 1979, wherein it was held that a partnership firm under the Indian Partnership Act is not a distinct legal entity apart from the partners constituting it. Firm as such has no separate right of its own in partnership assets. And when one talks of the firm's property or firm's asset, all that is meant is property or assets in which all partners have a joint or common interest. If that be the position, it is difficult to accord the contention that upon dissolution of firm's right in the partnership assets are extinguished. So even if there is a dissolution, the rights in the partner's right in the assets do not get extinguished. Their rights remain. The firm may dissolve, but the rights in the assets is always in the hands of the partners. The firm as such has no separate rights of its own in the partnership asset, but it is the partners who own jointly the common assets. So before the amendment made to 45.4 or section 9B, this was a position and the assessee used to take this position and there was no tax payable. And therefore the section 9B has been brought. Now if you see 45.4, if you now compare 45.4, 45.4 is taxable when there is a money or receipt of capital asset only in case of reconstitution. But if you see section 9B, it is taxable in case of income on receipt of capital asset or stock in trade by a partner from a firm on reconstitution or dissolution. So now dissolution is also included in 9B and reconstitution is also included. But in case of 45.4, only reconstitution is there. So what does section 9B technically says? Section 9B proposes section 9B taxes income on receipt of capital asset, income on receipt of stock in trade or both received in the hands of our partners or members at the time of dissolution or reconstitution to be taxable as capital gains or business income as the case may be. Now, if there is a receipt of stock in trade by a partner from a partnership firm, it would be taxable as a capital gain. Vice versa, if it is a capital asset received, it would be taxable as a capital gain in the hands of the firm. Now, for the purpose of section 9B and of course 45 also, reconstitution has been defined, according to which reconstitution includes one or more of its partners or members ceases to be a partner or member. So even if one partner is retiring from the existing partnership firm, it will fall within the definition of reconstitution. one or more new partners or members are admitted. So either admission or retirement, even of a single partner out of a partnership firm, would be reconsidered. However, at least one existing partner or member should continue to be a partner or member of the specified entity after admission of the new partner or member. So if there are two partners, only one should be admitted or retired, but at least one existing partner should continue, because if all the partners are existing partners are retiring and all the new partners are considered, then it would be treated as if you have dissolved the firm and the new firm has been formed. So third, all the partners or the members continue with change in their respective share or in share of some of them. So if there is a change in their respective share, or the either of the single partner or one or the two partners, not maybe all partners, if there is a change in the share of their profit share, then also it will be treated as reconstitution. So reconstitution has been defined. So once there is a reconstitution, the provisions of section 9B and the provisions of section 45(4) gets attracted. Now on that reconstitution, important is only a reconstitution is not important. Taxability arises if there is a receipt of money, capital asset, or stock in trade. If there is a receipt of money, it is taxable under 45(4). If it is a receipt of capital asset, it is taxable under 45(4) as well, section 9B, both places with no double taxation. Advocate provision is there under 48(3), that there won't be double taxation, 9B and 45(4). If there is a receipt of stock in trade, then section 9B would be applicable. So in either case, there has to be receipt by the partner. So amounts have to be received. So there may be an argument whether there is only a credit has been done to my account by way of money, or the credit is done by way of stock in trade. Obviously, once the credit or stock in trade is there, that means the stock in trade will be removed. Now, for the purpose of section 9B and 45(4), where there is a receipt of capital asset or receipt of stock in trade, the value has to be fair market value. It cannot be a book value. Now, let's take an example. To my mind, let's take an example of a bullion retailer, wherein there is a reconstitution happening, whether one partner is going out and another partner is getting admitted. And when the partner goes on out, as the capital account balance is there, he may be given a certain stock in trade to that extent. Now, when a stock in trade is given of a bullion, in the books, maybe that bullion may be standing at the value of 20,000, 25,000, whatever is the weighted average cost, because stock may be piled up over a time, maybe 4 or 5 years, where the gold prices were 25,000 or 30,000 possibly. Now the fair market value of the gold today is 50,000 for an example. So the tax would be payable as a business income of the stock in trade in the hands of the firm to the extent that stock is received by the outgoing partner. So if it is received by him, then this tax will be payable under section 9B on the fair market value. So compute the gains arising from the transfer of stock in trade. Transfer of stock in trade, as I said, fair market value of stock in trade is recorded as sale in firm book. So it's as good as sale, as good as the goods which are stock in trade, which is standing at 30,000 rupees. I'm selling at 50,000 rupees. So gold, I'm just giving an example because it's easier to understand today. This generally happens a lot of times in case of real estate developers, wherein the project is completed. There is certain unsold stock lying in the partnership firm. Now, because it's a stock in trade, initially they used to transfer it to the partners. Whatever stamp duty was been payable, they were paying the stamp duty on that. But the tax liability could have not been come into it because there was nothing. There was only a reconstitution firm was not been dissolved. So 45(4) or 45(4) was not applicable, erstwhile 45(4). And the management used to take into account. Now, section 9BB will be applicable in such cases wherein partnership is dissolved and the stock is transferred to the partners at the time of the dissolution also. Then the fair market value of that particular property. So unit may be, the cost of unit may be 5,000 per square feet if it's a office premises somewhere. But the fair market value may be 15,000. So cost that is appearing in the books of the firm would be treated only would be treated for the purpose of reduction, because that is your cost. But consideration would be fair market value, which will be 15,000, and difference between tax and the business income, or vice versa, capital gains as may be. Similarly, the computation, the gains arising from capital assets, computation of capital gain under 9B rate with 48(3) shall be as followed. As I said, that 9B is subject to tax already paid under 45(4). So for the purpose of section 9B, whatever full value of the consideration, fair market value of the capital asset has to be taken in. All the expenditure, cost of acquisition, index cost of acquisition, improvement would be allowed as deduction. And whatever tax has been already paid by the firm under section 45(4) will also be allowed as a deduction. And because it may happen that 45(4) tax would have been paid in the earlier years when the reconstitution happened to a certain extent and the amount was being paid under 45(4). So that is amount which is actually allocable to a particular capital asset, and that capital asset is now been allocated and tax was already paid under 45(4), that would be allowed as a deduction. So there won't be any double taxation. To summarize, as we have said, the 45(4) and 9B. 45(4), if you see the left-hand column, 45(4) is applicable at the time of reconstitution on income arising on receipt of money or capital assets. So important points are, it should be reconstitution, income should be reconstitution, and there should be receipt of money or capital asset. In a contrast, 9B includes dissolution or reconstitution. Taxability arises at the time of dissolutions as well as or reconstitution, and there should be receipt of capital asset or stock in trade. Capital asset being common, 48(3), there is a provision to avoid double taxation. I made this chart when I share this, you can see, because 45(4) and 9B applicability has been very difficult. As I've summarized in the earlier chart, I put it in a deviation column to make it easy. So a retirement of a partner. So if it's the most important first line, retirement of partner, and there is nothing is being paid, then there is no applicability of 45(4) and 9B, because there has to be a receipt of money, capital asset or stock in trade. If the outgoing partner does not receive anything, then both these sections are not applicable. Please keep it in mind as of today also. If the retirement of partner, if there is a money, then obviously 45(4) is applicable. If it's a capital asset, 45(4) and 9B both applicable. Stock in trade, only 9B is applicable. So similarly, when there is an admission of the partner, if you see no, yes, section 9B, the similar provision is applicable when there is an admission, because retirement and admission both amounts to the constitution. So this table will serve as a purpose. If there is a change in profit sharing ratio, and if the change in profit sharing ratio does not entails receipt of any money, capital asset or stock in trade by any of the partner, again, there's no taxability under either of the amended provisions, new provisions of the law. But if there is money being paid, the person who is reducing his profit share, he receives some money, capital asset or stock in trade. Based on that, applicability of 9B and 45(4) would be there. Similarly, on dissolution of money, if nothing is paid, there is no asset, only the capital account balance is not being paid, he withdraws his capital, no implications. But if money, capital asset, stock in trade is being paid, there would be an applicable of 9B, but 45(4) is not applicable at all on dissolution. 45(4) is only applicable on reconstitution, which is retirement, admission, and change in PSR. I've taken an example on section 45(4) and 9B. So there are 2 financial years I have kept it in mind. So let's take an example. There is a retirement of partner A from firm on 30th June 2021. Capital, current and loan balance up to 30th June 21 rupees 80 lakhs. Please mind it, I'm going with the presumption that even the loan balance would be treated as my capital account balance as mentioned in 45(4) for purpose of calculation of capital gains. Technically, all my loan balance in the partnership firm, loan is generally there's no loan. Whatever amounts are brought in is classified as a current balance. And current and capital is definitely capital, but there could be a dispute on account of loan balance. Now, this issue may not arise in case of partnership firm, because in the majority of partnership firms, there is no separate loan. All the funds received either as a loan is also being credited as a current account. But in case of LLPs, there is a permissible under the law, and there could be a provision in the contract wherein the amounts received towards a loan would be treated as a loan, because then they can rank pari passu with other loan creditors also. But otherwise, what will happen if it has been credited to a capital and current account in case of LLP? Then they loses on a waterfall mechanism. They will not be in a pari passu with the other loan creditors. And therefore, in LLP case, there may be a loan balance. In which case, there may be an issue whether the loan balance also would be treated as a cost, as a book value for the purpose of calculating capital gain. So I'm going under a presumption, though in case of LLPs, loan balances may be a disputed issue. So on a retirement on 30th June, he has a balance of 80 lakhs. I'm paying him a certain stock in trade. I'm transferring certain stock in trade on 15th of July. The fair market value is 7 lakhs. I'm making a payment of money on 31st August of 50 lakhs, and I'm also transferring a land on 30th April 22. It's after the end of the financial year. The fair market value of that asset is 45. So what I'm paying him is, I'm paying him a stock worth 7 lakh rupees, money 50 lakhs, and capital asset worth 45 lakhs. So question is 45 plus 50 plus 7 has to be taxed somehow, because that is the provisions of 9B and 45. First, for the assessment year 22-23, because the retirement has happened on 30th June 21, I have received stock in trade of 7 lakhs and money of 50 lakhs. There is no receipt of capital asset. So once I am receiving money, 45.4 will be applicable. I am receiving stock in trade 7 lakhs. Cost will be. So for the purpose of 9B in assessment year 2023, firm will pay tax on 1 lakh as a business profit. Fair market value of stock is 7 lakhs. Book value was 6 lakhs. So 1 lakh would be taxable as a business profits for the firm. This stock in trade received by the partner will be treated as sale by the firm, as good as a sale. Coming to 45.4 computation, that is money received. I received 50 lakhs. There's a capital balance of 80 lakhs. 80 lakhs in my earlier slide on 30th June. So I received short 30 lakhs. So there won't be any capital gains as far as receipt of capital asset is concerned. Nil. Coming to 23-24, I again receive a capital asset. Now the capital asset is chargeable under 9B and 45.4 also. So I will calculate a tax under 45.4 first, because the deduction under 48.3 would be then applied to 9B. Under 45.4, I received a capital asset, fair market value is 45 lakhs. Capital balance is now 30 lakhs. It has been reduced from 80, 50 was paid in last year. So 30 is the capital balance. So 15 lakhs would be taxable as capital gains under 45.4. What is tax under 45.4 would now be recalculated under section 9B, where these 9B computation there is a 45 lakhs, because there is no indexation available in 9B, not under 45. My index cost of particular asset is 15 lakhs. Now I am getting a deduction on index cost. So my 30 lakhs is the capital gains is a taxable under 9B, out of which 15 lakhs tax has been already paid under 45.4 calculation. So balance 15 will be taxed. So in nutshell, I am being taxed on 30 lakhs rupees as a capital gains, which is the calculation of 9B and 45. So this were the 2 or 3 major important amendments which I thought I should bring in notice. One was goodwill, slump sale, and 45.4 and 9B, which requires a detailed considerations in this particular finance act. Now, another 4th one, obviously, other than other small amendments, the other major amendments is liable to tax definition has been inserted in section 2(29)(a) from assessment year 21-22 again. So financial year 2021. If you recollect, there was a new section inserted in section 6(1)(a) by last Finance Act 2022. What did the Finance 6(1)(a) says? As per section 6(1)(a), an individual being citizen of India, having total income exceeding INR 15 lakhs. So I am a citizen of India. My income is exceeding 15 lakhs. Then he shall be deemed to be resident in India only if he is not liable to tax in any other country. So there was a deeming provision that even if I am not a resident, I am staying outside. Individual is not resident as per section 6(1), that 182 days criteria. Then also section 6(1)(a) figures, if my income is exceeding 15 lakhs and I am not liable to tax in any other country. So this was, according to me, this was to cover the people who used to manage their stay in various countries, and under the provisions of their various local laws as well as DTAA, the person was in air. He was not a tax resident in any of those countries. So 6(1)(a) was brought. If such a person who is not a resident of any this particular country is not, because of his residential status, is not liable to tax in that particular country, then obviously, he, as being a citizen of India, he would be treated as a resident for all practical purposes. But the criteria of 50 lakhs income was. Now, this liable to tax was not defined anywhere when the 6(1)(a) was inserted, which has been defined now. It says liable to tax in by insertion of section 2(29)(A). Liable to tax in relation to a person and with reference to a country. So it has to be in relation to person and with reference to a country where he has abode, where he has stayed for some period, means that there is an income tax liability on such person under the law of that country for the time being enforced, and shall include a person who has subsequently been exempted from such liability under the law of that country. So liable to tax in that country, if he is not liable, so I should be liable to tax in that country. If I'm not liable to tax in that particular country, then obviously 6(1)(a) does not apply. then only 6 bracket 1A clause. So if I am liable to tax in that country, I will be taxable. So what do we mean by liable to tax? It has been made reference to a particular country of, and under that particular law of that country, even if it's subsequently exempted, still he may be treated as liable to tax. So the liability to tax may arise in that case. If it arises 6(1)(a), I am out. I may not be paying any tax according to me. There may not be tax liability in that particular country, but I still remain liable to tax under the provisions of that particular law of that particular country. Another small amendment. So I'll try to cover small amendments before I go to the procedural amendments, which has happened in 148A assessment proceedings. I would like to cover other small amendments, and then I'll go to the procedural amendments in detail. There is an amendment made in 36(1)(5)(a), payment of employee contribution to fund on or before due date. So there are two contributions of PF which we are doing. One is employees contribution, employers contribution. There is no dispute as far as employers contribution is concerned that employers contribution is covered under section 43B. So if there is a delay in depositing employers contribution, they were allowed under 43B irrespective. But the stand of the department was that employees contribution is not covered under 43B, and therefore, and it is covered under 36(1)(b)(5)(a), small Roman a, small 5 Roman 5A. So is not covered, and if there is a delay in depositing employees contribution, it has to be disallowed. You would have come across a lot of 143(1)(a) notices also coming in last 2 years, 3 years by CPC, adjustment been made on account of delays reported in employees contribution in tax audit report. Based on that, they are disallowing employees contribution. Though there were judgment to that extent, wherein it says that even the employees contribution is covered under 43B, and even if there was a delay, but if it is ultimately deposited before due date, it should have been allowed. Now, to overcome this judgment, an amendment has been made in 36(1)(a), an explanation by way of amendment, an explanation has been added. The wordings of explanation indicate that the clarification is retrospective in nature. It says, however, in the memorandum budget, it has been mentioned that the state amendment will apply from assessment year 21-22 and onwards. According, there still exists a gray as to whether existing litigation will get the benefit of various court rulings or benefits will be denied due to such. So there is an amendment made which says that it is a clarificatory in nature. Now, once you say it's clarificatory in nature, there could be a legal dispute wherein department would claim that this amendment, this explanation has to be treated as retrospective. And all the pending appeals, all the pending adjustments, all the pending issues which are open on this account may also be considered, and you may have to dispute it. Though the memorandum of budget is very clear that this explanation is prospective and will apply from assessment year 21-22, but there could be a litigation on this account, and department may claim that it is a retrospective because the wordings used are clarificatory in nature. Therefore, we may have to still litigate on this. But my view would be that as we should, in the previous years, we should claim the benefit only from financial year 2021, assessment year 2021-22. If there is a delay, we may not claim it. Another amendment is in regard to 43CA and 56(2)(10), wherein the safe harbor limit has increased from 10% to 20%, only up to 30th June. So this is well known. I thought I'll just brush it out. So if there is a difference between the transaction in case of immovable property sale and purchase between 43CA, between a builder, it's a new property, not a resale. Only in case of a transaction of a new property between a builder and the buyer of the property, the 43CA is applicable to builders, 56(2)(10) is applicable to buyer. So if the property difference between the stamp duty and transaction value is not less than 10%, then these sections were not invoked and no tax was liable. Now this 10% has been increased to 20% in view of pandemic. 44AB, exemptions from audit. Everybody knows that the provision for the 44AB is X 1 crore. Technically under section 44AB, if the turnover of any assessee exceeds ₹1 crore, such assessee was liable to get their accounts audited. Now there was an exemption, there was a value raised to the 5 crores in case the certain conditions were fulfilled, where the receipts or the payments were not exceeding 5% in more than cash. In such cases, the threshold limit for financial 1920 was 5 crores. Now this 5 crores has been further increased to 10 crores for this financial year, the audits which will be undergoing now, financial year 2021. If your turnover of the assessee is less than 10 crores and the cash payments or cash receipts does not exceed 5%, then that particular assessor will not be under the audit and no 44 LUP audit has been to be required. Now this higher threshold limit of 5%, there is little change in which used to talk of cash receipt and cash payment. Now it says receipt payment other than account pay checks. So instead of mentioning of 5% of cash receipts and payments, now it says 5%, it should not exceed 5% other than account pay checks. So only account pay checks will be considered. So your account pay checks turnover payments and receipts should be more than 95%. If it's a payments are through cross-border checks, they will be treated as cash payments or other than account pay checks. And this condition of 5% would be applicable. They will be considered in the 5%. If you exceed such 5%, you will not get the benefit of the higher threshold limit of 10 crores. Presumptive taxation as per section 44 ADA. There's a small amendment. As per the 44, HUF is also not eligible for presumptive taxation scheme under section 44 ADA. Eligible only resident individual and resident partnership funds. Not eligible LLP, HUF, company, EOP, boy. So initially up to last year, up to the amendment, HUF was also eligible under section 44 ADA presumptive tax. Now HUF has been also removed from the definition of eligible assessee. So HUF will not be eligible. I'm sure this is to restrict the various capital formation transactions been happening in the country. Time limit for written filing and assessment. If you see the various amendments which have been made during Finance Act 20, then there was 2 ordinances issued in September, 25th September somewhere, and in October, and now with the Finance Act 2021, the idea of the government is very clear to bring certainty in the tax laws. When can the certainty bring? When the period of the filing your return and the assessment is shortened. So they have made a conscious efforts to reduce this time period. So for purpose of reducing the time period, obviously there has to be reduction in time limit of filing the return of income, then filing of belated return, filing of revised return, filing of issuance of notice under 143(2), and passing an order under 143(3). So there is a conscious effort being made by the government to reduce the timeline, wherein the finality of the assessment can be known within 2 years period from the end of the financial year. So the time has been reduced. Accordingly, to give effect to this idea, to bring the certainty of taxation, to reducing the time limit, time gap between the end of the financial year when the transactions have taken place and the assessment takes place, the time limits have been reduced further by 3 months across the board. So filing of return of income, though there is no time limit change in 139(1), the belated return which was hitherto up to March 22 now would be have to be filed December 2021. So for your assessment year 21-22, when you are now filing the returns, you can file the belated return only up till December and not up till the March. Well, similarly, the revised return, the return which you would be filing in July, now extended in September for the individual cases. The belated, the revised can be filed before December. Similarly, 143(1), the intimation and scrutiny notice, the 3 months time period, the September 22, which was an original time limit for scrutiny notice, has been reduced to June 22. So 3 months from the end of the assessment year. So for the assessment year 21-22, which ends on March 22, it has to be filed before 30th June 22. So if you see for assessment year financial year 19-20, the assessment year 20-21, which is relevant at 21-22, I tried to compile the various due dates. So if you see the assessment year 21-22, for the purpose of which the last column, we will be filing a return for financial year 2021, previous year 2021. The due date of ITR is October. I'm taking the audit cases. Belated has to be filed by December. Processing of return under 143 has to be before December 22, because in any case, scrutiny order also has to be passed by before December 22. And time limit for issuance of notices 30th June 22. So that is practically only 6 months time limit. If somebody is issuing a scrutiny notice before June 22 for the return filed now in October 21, he gets only a time of 9 months to issue 143(2) notice. And similarly, the assessment also has to be made within the 6 months. So there is an overall reduction of time. Now there is an amendment made in section 143(1)(a). The 143(1)(a) looks after prima facie adjustment which can be done in an intimation. Though it is called an intimation, various courts have been held that it is an order, it is an appealable order. You can also appeal against the order intimation under section 143(1)(a). There is certain changes made in the 143(1)(a) permitted certain prima facie adjustments can be made, like arithmetical errors, incorrect claims can be made. Now there is little change been made in item 4 and 5. So disallowance of expenditure indicated in the audit report but not taken into account in the computing. Now 143 1A will also include disallowance of expenditure indicated. It was there earlier. Now this disallowance of expenditure or increase in income indicated. So if my tax audit reports shows some increase in the income indicated and I am not included in computing the total income of income, then the said adjustment can be made in 143 1A. If that the only disallowance was concerned. Similar restrictions, similar amendment has been made in this category of serial number 5 on my screen. When in section 10AA or under any other provisions of chapter 6A under the heading C has been included. So there was only a specific mention of particular sections. Now they have included all deductions claimed under chapter 6A in respect of certain incomes. So if there is any variance between my tax audit report claimed as far as from chapter 6A deductions are claimed, then definitely this can be done. The major amendment which has come in is procedure of section 148, issuance of notice under 47. Complete new provisions have come. The new section 148 capital A has been inserted. What does section 148 capital A says? First, we'll look into it. And when this 148 capital A is applicable, we'll look into it. First of all, what does 148A says? There is a new procedure which has come to it. It says that assessing officer is required to conduct an inquiry. So reopening notice before issuing notice under section 148. As before issuing reassessment of 148, need to follow the procedure under 148. So pehla 148 ka procedure follow. Then you issue a notice under section 148. What is the procedure under section 148? He has to conduct an inquiry. What do you mean by conducting? First, he has to take a prior approval of certain specified authorities as mentioned in the law with respect to information available with the assessing officer, which suggests that the income chargeable to tax has escaped assessment. There is a change in the wordings if you see the that to 147, 148 provisions. Now, information available, it says suggest. So reason to believe has gone, it says suggest. That there is an income chargeable tax has to escape. So he has to conduct an inquiry before issuance of notice under 148. After conducting an in-house inquiry, after taking the prior approval of specified authority, based on information available to him, which suggests that there is an escapement of income, he will conduct an inquiry. Once an inquiry is conducted, he has to grant an opportunity to the assessee. So opportunity of being heard has to be granted. Now, even before granting an opportunity of being heard, the approval of specified authority has to be taken. And a show cause notice has to be issued that why a proceedings under section 148 should not be initiated against a particular assessor. Then, based on that show cause notice, his reply has to be considered. And after considering the reply, he has to pass an order after approval of specified authority on basis of material available or record and reply with the assessee within 1 month of assessor's reply. So please note, now which we are saying it, there is an 148 bin is issued lock, stock and barrel. There is no communication with the assessee before issuance of notice under section 148. The internal approval procedure is also a make-believe. We do not know what note has been put up, how the satisfaction of the commissioner has been recorded, and 148 has been issued. After the new procedure coming in 148 capital A, he has to conduct an inquiry on the material which is available before him. And for conducting inquiry also, he has to take an approval of specified authority. So there is a three-way process of specified authority. First, here before initiating an inquiry, he has to take a specified authority. After conducting an inquiry, if he feel that I should go ahead with the reopening provisions, then he has to issue a show cause notice. Now, even before issuance of show cause notice, he has to again take an approval of specified authority. After taking an approval, only he can issue a show cause notice. Once a show cause notice is issued, he is duty bound to consider my reply and then pass an order. Now, passing an order for reopening also has to be after the specified authorities approval. So, specified authorities approval is there at all the three levels before the notice is issued under 148. If I have to understand properly, before issues of notice under 148, specified authority, who's specified authority? I'll go in the next slide. So he has to take 3 times the approval of specified authority. So, assessing officer cannot act in a biased manner. He is answerable to a specified authority. He will have to explain how the inquiry was conducted, why he has come to a conclusion that there is a suggestion that income has escaped assessment. Then there was a show cause notice issued, and the assessee has replied to that, which has been considered, and only after that an order has been passed for initiating the reopening proceedings. So there is an advocate safeguard under section 48 capital A, according to me, and it looks quite good if it is followed religiously in the manner. If they are not following, I am sure these are substantial provisions, and if any of this particular procedure which goes root to the jurisdiction of reopening under section 148, then possibly they would be violating law, and there may be a case where there may be an argument wherein even the reassessment proceedings will be caused. So amendment reassessment, following conditions. So what does section 147 completion of review of assessments is? Following condition needs to be satisfied. Any income chargeable to tax has escaped for any assessment year, and assessing officers follows the provisions of 148 to 50. Section 148 issue of notice. In case other, it's amended. In case other than search, survey, or requisition, information shall deem to be suggesting that income chargeable to tax has escaped assessment. Any information flagged accordance with the risk management strategy, any final objection raised by CAG. So what is an information that suggests income chargeable to tax? So there is a deeming suggestion made that if some information is flagged by a risk management strategy, so the CBDT would be developing a risk management strategy. Based on risk management strategy, if particular transaction has been flagged, then those transactions would be deemed to be suggesting that income chargeable to tax has escaped assessment, and 148 notices, 148 proceedings can be initiated. In case of search, survey, or requisition cases, after 1st April 21, so any cases after 1st April 21, search, survey will also be subject to procedure under 148, will be subject to 148 assessment, non-148 procedure, because the search has been kept out, but the survey has been kept in. So in case of the survey, the assessing officer will have to follow section 148 procedure, but in case of the search, assessing officer can issue directly the notice under section 148. But please keep it in mind, currently the search, in case of the search, the assessing officer is obliged to issue a notice under 153 capital A for the previous 6 years. In the previous 6 years from the year in which the search has taken place. Now, the assessment of the search will also be made in accordance under section 148, 147 only. There's no separate provisions. 153A will not be applicable from 1st April 2021. Only safeguard, only leeway available through the department is in case of the search, they did not go through a procedure as prescribed under 148A, they can directly issue notice under section 148. So section 148 procedure to be followed before issuing a notice under 148. We have covered in that slide. The aforesaid procedure does not apply in search. However, in case of survey, AO has to follow the procedure. So all cases to be followed except search. Now there is also amendment made in the time limit for reopening of the assessment. Section 149. In case of non-serious tax evasions, reduced from 3 years to 6 years. Now, when this was announced by the finance minister, a lot of people said, yes, the period has been reduced from 3 years to 6 years. But according to me, this is not a very big thing, because on another, in case of serious tax evasions, the period has increased to 10 years. So even in case of non-search, initially only in case of search year, 6 to 10 was allowable if the income escapement assessment was more than 50 lakhs for a one particular year. So in case of such, 6 to 10 could have gone. Now in the normal course also, after this amendment in section 49, from 3 to 10 years you can go if there is an tax escape assessment of 50 lakhs. According to me, 50 lakhs is very less. Though there is a part, if you read serious tax evasion provisions, it says AO in possession of books of accounts or other documents or evidence which reveal that income chargeable to tax is represented in form of asset. So important is asset, it should be there, which has escaped assessment 50 lakhs. So if you read form of asset, which was the similar wordings which has been used from 153A, wherein also from 6 to 10 years, the period could have been extended if there was an income chargeable to tax represented in form of asset which has escaped assessment more than 50 lakhs. So similar, so form of asset means if there is some expenditure recorded in your books of accounts and it has been seized during the search, or it has been come to the knowledge of the assessing officer through an information and he wants to resort to the opening, he cannot do it because it's an expenditure. that income is not represented in form of assets. So income has to be represented in form of assets. It could be immovable property, it could be any capital rights, it could be rights, it could be bullions, it could be jewelry or stock in trade. Those all are in nature of form of asset. So there can be an argument that stock in trade is not an asset, that's a different thing. But according to me, it would be covered. Now, question is whether 50 lakhs is sufficient or not. 50 lakhs, if I go at nowadays, 50 lakhs is worth like 1 kilo jewelry, which is minuscule. So in most of cases, an extension from 3 to 10 years can happen in a particular year if some jewelry is found more than 50 lakhs in those particular years. And now it need not be only in case of search. In the normal courses also 3 to 10 years you can go. But in case of a non-serious tax evasions, where there is an amount, only it will be up to 3 years only. You cannot go beyond 3 years below 50 lakhs. So if you have section 151 is a sanction authority which has been now amended, there is a specified authority been mentioned in section 148 for the purpose of certificate. If the assessment has been reopened, if it's within 3 years or less than 3 years have elapsed from the end of the 11th assessment year, then you have to have an approval of the principal commissioner. That is commissioner rank, principal commissioner, principal director or commissioner. If it's more than 3 years, it's a principal chief commissioner or a director general. So it's a rank of, there is 2 ranks. One is commissioner rank, one is the chief commissioner rank. Up to 3 years commissioner, about 3 years chief commissioner. It's a very welcome move. You were aware that up to 4 years, even the approval of joint commission was enough. And if AO is below the rank of joint commission, then all the satisfaction of joint commission was enough. Now, after 4 years, only commissioner or chief commissioner had a dual role for giving an approval. Now, even up to 3 years, you will have a rank of a commissioner who will have to give satisfaction or approval. Now, the word satisfied has been now replaced by the word approved. So there is no satisfaction. Initially, there was a satisfaction. Now it's an approval. There are a lot of judgments wherein it has been held that the mechanical satisfaction is there has to be an objective satisfaction. So commissioner would not only say that I am satisfied for reopening. AO used to put a note and he would have said, yes, I am satisfied. And based on note, a reopening notice was been issued. The courts have held that this is not a satisfaction. Satisfaction has to be objective. Proper reasons, proper application of mind should come out of this satisfaction. Now the question may arise, because the satisfied has been replaced by words approved, whether those judgments would be applicable, whether you can challenge that the satisfaction is mechanical, there is non-application of mind, because it requires only an approval of an authority in place of another authority. So this would be a challenge. We'll have to wait and watch how judicial authorities interpret the words approved means, whether approved means be pure signatures, only a signatures that it has been approved, or it has to be an objective approval. Comparison of existing procedures and amended procedures. When a notice can be under 148 can be issued, AO has reason to believe. Now A has current, it requires AO has information which suggests that income has escaped. So reasons have been amended with suggest. Procedure, record reasons. Current procedure says you record reasons to believe the income has escaped. Now you have to follow a 148 capital A procedure, 4 point, which we have discussed. Sanctioning authority up to 4 years was joint commissioner and then commissioner. Now up to 3 years, it's commissioner. After 3 years, it's chief commissioner rank. Time limit 4 to 16 years. 16 years was in case of black money. Now it's 3 to 10 years. Up to 3 and 3 to 10 years. Comparison of new scheme and old scheme. As you know, reassessment has been the favorite subject of all the professionals. You keep on challenging the reassessment notice. There are various judgments. There are divergence views that whether the reopening was valid or not, reopening, whether the reason to believe was valid or not, whether the information was correct or not. So I've just tried to make a comparison between the existing procedures and amended procedures. If you see the existing procedure, according to me, even after the amendment made, the following now deleted and continue under the new provision. So the reason to believe more than 4 years failure on the part of assessing. If beyond 4 years in the current provisions, you had to do a reopening, then there has to be failure on the part of assessing. Foreign assets reopening up to 16 years. So all those have been removed now. But according to me, even in the current versions, change of opinion will continue. Income escaping assessment, jurisdictional AO cannot reopen for verifications. There has to be a suggestion that income has escaped. You cannot just reopen for making a verification or roving inquiries. There are various judgments. That 148 itself is in a big subject itself. Recording of reasons in form of passing an order. So though the reasons to believe has not to be recorded, but in 148 procedure, ultimately he has to pass an order. I'm sure that order has to be objective. So obviously that order will replace by recording of reasons will replace by an order which will be more objective and much better than the reasons which have been now communicated. Issues related to service, approval of specified authorities, and procedure of assessment. So all this will continue in the new procedure also. Other various small amendments which I would like to cover. Income Tax Settlement Commission. Income Tax Settlement Commission with effect from 1st October, 1st Feb 2021 has been discontinued. So you cannot make any fresh application before settlement commissions. Whatever settlement commissions which were admitted under 245(2) would continue to be decided by the interim board, which will be decided. So those have been classified as the pending cases. So pending cases as on 31st January 2021, which have been admitted by the settlement, they will be decided by the settlement commission in the normal course, but not by the settlement commission, but by an interim board to be formed. Interim board has not been formed, so interim board will be formed, and that interim board will decide those particular cases. But from 1st Feb 2021, you cannot go to the settlement commission. I don't understand the settlement. Obviously, the government has its own reasons for discontinuing the settlement commission. The settlement commission was being used as an escape route during the course of search. So there was no limit. If there was a search proceedings and if the government used to unearth a large amount of assets or income, there was an option available to associate to approach settlement commission, pay tax along with the interest, and save himself from the penalty and prosecution. So once the settlement commission is not there, so this escape route available from penalty and prosecution will not be available from 1st Feb 2021. So in all those such cases where the assessment has been made, you have no choice but to litigate those. And the litigations will only not remain to the quantum assessment, tax, but it may now extend to penalty or prosecution. So the settlement commission was like one-time declaration scheme where you declare, you come clean, whatever data was found during the search, you calculate your income, pay taxes, seek immunity from penalties and prosecutions, and you were getting it. I know settlement commissions was been misused. Government were aware that settlement commission was misused, and a lot of unethical practices were happening, and that is the major reason behind this, that the settlement commission has been scrapped. Now, this settlement commission, after scrapping, I'm sure the search proceedings, once the search happens, the implications could be quite high. And the way we are seeing the government is taking an action as far as prosecution is concerned, I would not be surprised if the number of prosecution cases increases as far as search is concerned, or so and so forth. Now, as far as this time period will be excluded for reassessment, so all the cases which are pending would now be automatic. If they have not been admitted as on 1st Feb, but those were been filed, then assessing officer, it will go back to AO to make an assessment. Because once you were making a settlement commission application, all your assessment was being stopped. So that period would be excluded till the time this were pending before settlement commission and not amended. So all these time limits will accordingly amended. Another amendments have been made in TDS amendments. One is in section 94, exemption from TDS on payment of dividend to business. If pay is individual, from payment of dividend to a business trust. So if the pay is an individual, TDS at 10% if amounts, the pay is not no threshold. So amendment is brought in section 94 that no TDS is required to be deducted. This is existing provision where TDS is deducted at 10%. So if exceeding 5,000, otherwise directly 10%. So now if the TDS has been paid to a business trust by SPV, then there is no TDS. So it's an exemption from TDS in case of business trust. Section 194A, no TDS on payment of interest by infrastructure debt fund. Tax shall not be deducted on income in relation to zero coupon bond issued by infrastructure debt fund. So infrastructure debt funds, they are issuing zero coupon bonds. So if any dividend TDS is not there applicable on such interest instruments. Section 194 IB, deduction of income tax from payment of rent by certain individuals or Hindu HUF. So when you are paying the rent under 194 IB, that has to be TDS has to be deducted. In case tax is required to be deducted as per provision of 206 AA, non-furnishing of PAN or 206 AB, higher rate of TDS for non, such deduction shall not exceed the rent payable for last month or previous year or last month of tenancy as case may be. So if let's take an example, we were deducting TDS on the rent. Generally rent was being deducted in the last month, so that you will not deduct from 1 month for the residential. Even individual had to deduct this TDS, and 194 AB. Now there is a provision which has come of 206 AA and 6 AB, which prescribes for the penalty TDS. If there is no PAN as far as deductee is concerned, or he is a non-filer, you have to deduct a higher tax rate of 5%, 20%, depending of the provisions under 206 AA AB. So there is a limit put under 194 AB. Irrespective of 206 AA and AB, in any case, TDS will not exceed the rent payable for the last month. So if or the last month of the tenant, so if the tenancy is ending in the March, and the March is the last month before the end of the financial year, you are deducting TDS in the March, and the rent itself is 50,000, but because of applying 206 AA or AB, it increases to 75. It will be restricted to 50. 194P, conditional relaxation for senior citizens from filing of income tax also is there, and also TDS would not be deducted if you have only pension income from a one bank account. You don't maintain any other account, then you did not file return, there is no deduction also. 194Q, very important amendment, TDS on payment of certain sum for purchase of goods from resident. You know, last year there was an amendment made, 206C, subclause 1H was introduced, wherein TCS was being collected by the sellers if the turnover from a particular customer was more than 50 lakhs and my turnover, seller's turnover was more than 10 crores, I was collecting tax at 0.1% of sum exceeding 50 lakhs and depositing with the government. Now there's a reverse TDS has been brought in, wherein now the buyer, purchaser of the goods will have to deduct TDS, not TDS, if the buyer's turnover is more than 10 crores from a resident, and if he buyer's turnover, if he purchases of any goods more than 50 lakhs from a particular customer, particular supplier, he has to deduct TDS of 0.1%. Now there is an exception to TDS deduction. He need not deduct TDS under 194Q if he is deducting TDS under any other provisions, which according to me may not be. 2, if tax is collectible under the provisions of section 206C, other than a transaction to which subsection 1H of 206C applies. So 206 exception is from 206 TDS collection. So if you are collecting TCS under 206 for scrap, liquor sale, and so forth, not under subclause 1H, which is in relation to sale of the goods, then there is an exception. But if you are collecting TCS under 206C 1H on sale of goods, there is no exception provided under 194Q. So now the buyer will have to deduct TDS once he falls in that criteria, wherein his turnover is more than 10 crores and he buys the goods from one particular supplier more than 50 lakhs. Now question arises, what happens to 206C 1H? There is no amendment. But in the existing provisions of 206C bracket 1H, there is already a clause which says a TCS is not to be collected in case TDS is deducted under any section. So when I'm selling the goods, now I need not collect TCS only if TDS has been deducted by the buyer of the goods. So now I will have to keep a track. I will have to keep a declaration as a seller of the good that whether the buyer is going to deduct TDS. I would suggest that we should ask our clients to actually take a declaration from my buyers that whether I should collect TCS or not, because the buyer may deduct TDS or may not, depending upon his turnover, which I may not have an access to. I may be selling goods worth more than 50 lakhs, but I do not know that because his turnover is more than 10 crores or not, and whether he would be deducting TDS. If he deducts TDS, I do not collect TCS as a seller. So this mechanism will have to be evolved before 1st July 2021. I am aware that a lot of people a lot of big entities have already started taking declarations from their buyers that whether their turnover is more than 10 crores and whether they would be deducting TDS, so that they can discontinue with collection of TCS as far as this is concerned. Now, there may be a situation wherein somewhere TDS may not be collected by buyer, so TCS would be continued, because if my buyer of the goods is more than 50 lakhs, but his turnover is less than 10 crores, he is not subject to TDS. In such cases, seller will continue with TCS provisions. Section 196D, TDS on income of FIS from securities. When an agreement referred to in 90A1 or 90A1 applies to the payer, if the payer is furnished a certificate referred to in 94, there's a certificate of tax residency certificate 94 and 94. As a case may be, then income tax tenant shall be there at rate of 20% or rates or rate of income tax provided in such agreement. So either rate at 20% or at the rate under DTAA based on the tax residency certificate on the income of FIs from securities. There is a new provisions 206 AA, AB, CC, and So there are penal provisions CCA. So 206AA and AB has come in case of TDS where the deductee does not have a PAN or is not filing, is a non-filer for last 2 years, then a higher rate of TDS has to be deducted. Either the rate at which it is in force applicable rate or 20%, whichever is higher, or 5% in case of non-filer. So 20% in case of non-finishing of PAN and 5% in case of non-filer. Similarly, TCS also 5% higher rate would be applicable if non-finishing of PAN is there or non-filer of income tax return is there. In case the PAN is also not there, return is also not filed, and both are not there, then the rate, highest rate, either under 206AA or AB, that is 5% or 20%, whichever is the higher rate applicable, applying both the provisions of law 206AA and AB would be applied. Last small amendment 234F, delayed fees has been reduced from 5,000 to 1,000 and 10,000 to 5,000. Okay. Exempt interest 1011 and 1012 of the Act extended the limit of interest earned on contribution. This extended, if you know, employers who were making a voluntary contribution in a year to the employer to the PF account exceeding more than 750,000 initially proposed in the bill, then the interest in relation to that will not be taxable. 250,000. Now this, sorry, not 750, it was 250. So if employer was contributing, employee was contributing, making his own voluntary contribution more than 250,000, interest accrued as of now was not taxable. After amendment, this exemption has been restricted to interest earned on the contribution up to 250,000. Now this 250,000 has been increased to 5 lakhs in case there is no contribution from employer. So if employer is contributing, then the limits is 250,000. If employer is not contributing, then the limit is 15. So I made a chart. If amount contributed by employee is 1,50,000, whether employee contributed to fund, yes. Whether interest taxable, no. 450, yes, taxable only over and above 2 lakhs. If employer is not contributing in the last column any amount, then any amount on excess of 5 lakhs only would be taxable. Various other small amendments have been made in 1010B as far as ULIPs are concerned. 47 clause 7A. I'm not going into details. It's in relation to India Infrastructure Finance Company Limited, and the carry forward 72A specific amendment has been made in 72 capital A because the government is in process of selling off the PSUs. So only for the purpose of amalgamation of the PSUs, public sector units, tax loss should not happen in case of change of shareholding. Similar provisions have been done. 234C amendment has been made. Initially, in my initial discussion, we had said that 234C advanced tax deferment interest does not apply if the shortfall in tax deposit is on account of estimation of capital gains. Now this has been amended to include dividend. It's a good welcome move because that dividend also what the company, I am a shareholder, I do not know what my company would be declaring a dividend this year. So I cannot estimate it. And once I cannot estimate it, I have to pay an interest on that advance tax. So 234C will be now applicable only on that income where there is a shortfall of tax deposited on that income, excluding income on dividend also. Initially it was capital gains and another income only. Another small 281B provisional attachment to protect revenue. The said section provides for provisional attachment of any property belonging to assessee by the AO with the prior approval of authorized specified thread in case of pending assessment or reassessment proceedings so as to protect the interest of revenue. So pending assessment, the powers under 281 capital B were available to assessing officer after the approval of the specified authority to attach your assets. So though there is no demand against you, 136 would have not raised, 281B permitted in particular cases, in a particular circumstances to attach. Now with effect from 1st April to the provisional attachment of property of the assessee may also be made during pendency of proceedings for imposition of penalty under 271AA, where the amount or aggregate of amounts of penalty likely to be imposed under section 2 exceeds 2 crore. 271AA, if the penalty likely to exceed under 271AA is more than 2 crores, then also this resort to 281B can be taken by making a provisional attachment pending imposition of penalty. Now 271AA deals with the penalty with respect of bogus entries, bogus provisions, which was introduced, I think, so last year. the small dispute resolution committee has proposed under has bring in section 245 MA. I think so. This committee has not yet been formed, though it has come in the act. This it's in regard to the small taxpayers, wherein you have if the assessment has been made on you and your return income, your total income was less than 50 lakhs, and based after the assessment, your disputed income is less than 10 lakhs. Then you can actually approach to dispute resolution committee and get the matter settled. So there is a reduction on penalty. So there is really powers to reduce or waive any penalty and grant immunity from prosecution. So instead of going and appeal, if you feel that the disputed income up to rupees 10 lakhs, you can approach the dispute resolution committee to be formed. Subject to, it's only applicable to taxpayers whose total income, return income, as per your return total income was less than 50 lakhs, and the assessment or disputes between you and the department is less than 10 lakhs, you can go to DRC rather than going into appellate processions, then fighting for penalty, and maybe even the prosecution may be launched. Even the DRC will function in an, it says may function in an faceless manner. That's what is proposed. Last amendment, which is in regard to section 89A, taxation in income from retirement benefit account. The non-residents, the resident specified people means a person resident in India who had opened a retirement benefit account while he was a non-resident or he was working abroad. So those retirement benefit accounts keep on continuing, and whenever there's a withdrawal made after the retirement, after coming to India, he becomes a resident. But when the withdrawal comes, there is a taxation happening in that particular country where this retirement benefit account is in. So an exemption is given, a relief has been given under 89A from such mismatch of taxation, double taxation. To provide relief from double taxation due to mismatch of taxation on income from withdrawal of retirement benefit account maintained by specified person in notified country on account of amount being taxable in notified state on receipt basis, while being taxable in India on accrual basis, the details of application have to be prescribed by the central government. So there would be an exemption provided, double taxation relief provided in this case. Provisions, details of applications will be prescribed. Thank you very much. Thank you. I've tried to complete all areas, the important ones at this. We have last 10 minutes. If any questions, we can cover.
Yes, sir. Thanks a lot for the question, sir. It's like a taxation guru giving us all the yarn today so that we can update our taxation knowledge. So thank you for that, sir, on behalf of our members of study circle. I would request if any members have any questions or any queries, we resolve. There was few questions which was posted.
There's a two questions in chat box. I will just cover up that. Okay. Ganesh has mentioned that does account pay checks include NEFT, RTGS, etc. for purpose of 44AB? Yes, it should be. It's as good as account pay checks. So the checks are not been issued, but it's a digital payment. So in all respect, it would be included. It would be covered for 95%. The account pay NEFT, RTGS should be treated as account pay only, and not an exception. So your threshold limit based on that can be worked out. There's another question in Manish Joshi. In assessment timeline, there seems to be some typo error in mentioning years. I'll have to look to it, Manish. I don't know. Himanshu, how to compute interest above employees of about 2,50,000? What is Met God? Didn't understand. Himanshu, if you can just. Question is, I'm sure there is a difficulty in applying the provisions. That if you are contributing more than 2,50,000 by employees contributing, then interest in respect of contribution made, how to calculate and how to offer for taxation, this issue will remain. I appreciate, I am sure it should be on the proportionate basis only, but there is no mechanism as such provided. So if I'm getting, if my total contribution, my opening balance is 100, for an example, 10 lakhs, I'm contributing 3 lakhs today. So my contribution is 13 lakhs. I'm receiving interest on 13 lakhs. Now my taxable portion of interest is only 50,000. So it should be on a proportionate basis. Or in an alternate, there is a declaration of rate of interest by EPF on year-to-year basis. So if this year they have declared 7%, that's for an example, return. So any amount above amount of 2,50,000, my contribution is 1 lakh, 7%, 7,000 should be offered for tax according to that. Sure, Manishji, I will check on that. Manishji has said that some due date in my presentation, there is some year mismatch, it seems. I'll do that. Shanbaji, will the calculation apply on a contribution for the year contributed and hereafter every year on such amount? Yes, according to me, it should apply. Every year it will continue. So I have whatever questions. Himanshu, I'll share PPT. Definitely, I'll do that. I'll share with Pankaj, so he can share with the members of the.
Yes, sir. I'll forward it to Himanshu.
Thank you very much. Thank you.
Any more questions from the members? Please feel free to ask. Shikha ma'am, are you there? I guess there are no more questions. Once more, I would like to express my gratitude to this VCM sir. I would like to invite Mr. Akshay Undia. Please offer a vote of thanks to sir.
Thank you very much, Chembur CP Study Circle, for giving me this opportunity for providing hearty vote of thanks. Reading through Finance Bill as one aspect and understanding the complex Finance Act in depth by we professionals and implementing in our practice is another. Given a limited period of time, you have given us in-depth analysis of provision of depreciation of intangible assets, slump sale, partnership act, and other amendments along with various case laws. Thank you very much, CA Piyush Chhajed, for going through detailed analysis of Finance Act 2021. I'm sure members of this study circle are very much more enlightened and updated with the Finance Act 2021. Thank you, CA Piyush Chhajed. Once again, we are also thankful to our conveners, CA Pankaj Ahuja and CA Shikha Rastogi, for organizing this seminar and all participating members. Thank you very much, sir.
Thank you.
Thank you once again, sir. With this,
Thank you, Pankaj. Thank you for your. Shikha has come. Thanks, Shikha.
Thank you, sir. Thank you for the wonderful presentation.
Thank you.
Shikha ma'am.
Yeah, very nice presentation, sir. And we are getting very good compliments also, comments for the presentation.
Thank you. Thank you.
It's really very helpful and very in-depth analysis of all the case, provisions. Thank you very much.
Thank you once again, sir. Look forward to meeting you soon.
Chhajed and Doshi.
Yes, sir. Thank you once again, sir. Thank you all the members for attending today. Thank you to Shikha ma'am. Thank you,
Thanks,
Akshay.
Pankaj, for organizing this webinar. Really very helpful.
Look forward to meet everyone very soon. Till that time, please stay safe. Thank you.
Thanks. And we will share this PPT with all the members. Okay, Pankaj? So this is very, important.
Yeah. Once I receive it, I will share it. Thank you, Shikha ma'am. Take care, ma'am.
Yeah, thank you.